Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. There's about 30 minutes to go now until the closing bell, and stocks, little change here. The S&P 500 on track for a losing week amid earnings and uncertainty at the Fed. Our very own Inez Ferre standing by with the headlines. Inez.
Yeah, Josh, we have been seeing the major averages around the flat line going into negative territory earlier today. This is after President Trump's comments, basically stepping back a bit from the possibility of picking Kevin Hassett as a next Fed chair. So that's when you saw the markets going lower. And it's been a little bit choppy throughout the session. But as you mentioned, if we take a look at the 5-day average here, we are seeing that over the last 5 days, we are heading into a losing week for all three major averages. The S&P 500, the NASDAQ, and the Dow. Taking a look at the sector action, we have seen rotation into sectors like we're looking at real estate, industrials, but I want to pull up a 5-day chart so you can see where the action has been. As I mentioned, the leadership in real estate, consumer staples, industrials, energy, and utilities. And the strategist telling us not necessarily going away from tech, but just broadening a bit with what we're seeing with the sector action. And the year-to-date chart, you can see some of that leadership there as well. Taking a look over on the NASDAQ, a little bit of a mixed picture on the daily basis for the Mag 7. But if we take a look at a 5-day chart, you will see also a mixed picture there with Microsoft, Amazon, Meta heading into a losing week, Apple as well. But you're looking at NVIDIA and Broadcom that are in the green. And then just looking over on the semiconductor space, as I mentioned, we have been seeing some leadership in semiconductors this week, especially after TSMC's results that were announced earlier this week. On the Bitcoin front, we are seeing that crypto has had a good week with Bitcoin up 4% over the last 5 days. And just rounding it out with what we've been watching in the commodity space, some volatility with commodities this week with Brent crude up 0.6%, but and also, Brent and then also WTI both up less than 1% for the day, and gold down, retreating, as well as silver. Josh?
All right, Inez, thank you. Appreciate it. Well, President Trump gave a signal of who he may not want to nominate as Fed chair at a White House event earlier. Yahoo Finance Fed correspondent Jennifer Schonberg has the very latest. Jen.
Hey there, Josh. Investors now see former Fed Governor Kevin Warsh as the front-runner to be the next chairman of the Federal Reserve after President Trump this morning said he is inclined to keep National Economic Council Director Kevin Hassett as one of his top economic advisors.
I see Kevin's in the audience, and I just want to thank you. You were fantastic on television today. I actually want to keep you where you are, if you want to know the truth.
Now, bets on Warsh have been rising, now 60% odds, according to Polymarket, as Hassett has plummeted to just 15%. Now, the president's comment comes in the wake of the Justice Department's criminal probe into Fed Chair Jay Powell, which has likely taken Hassett out of the running. The investigation has raised concerns by Republicans in the Senate about Fed independence, creating scrutiny around whoever Trump ends up appointing and that person's perception to uphold Federal Reserve independence. Hassett, who is close to the president, could be harder to confirm because of the belief that he may do what the president wants instead of what the economy needs. Now, Warsh, on the other hand, is not close to the president and is well liked by Senate Republicans and therefore could be easier to confirm. He also shares the same views as the president, that is that you can have a strong economy while still lowering rates. Warsh says he believes we are going to experience a boom in productivity because of AI, which will help bring down inflation. Now, also on the short list to be the next Fed chair are current Fed Governor Chris Waller and Rick Rieder, the head of global fixed income for BlackRock. Josh?
And Jen, while we got you, we got a slew of Fed speak this week, some fresh commentary this afternoon. What can you tell us?
Yeah, that's right. We're just hearing from Fed Vice Chair Philip Jefferson, who is striking an optimistic note on the economy for 2026. He says the economy looks strong. He thinks that the job market is showing signs of stabilizing, and he does see a path for inflation to sustainably come back down to 2%. He views those tariffs as one-off effects. Now, he noted that since the Fed had cut 3 times at the tail end of last year, that, quote, the Fed is well positioned to determine the extent and timing of additional adjustments, essentially lifting language straight from the Fed's December policy statement. Now, we also heard from another Fed governor earlier this morning, Michelle Bowman, who's also the Fed's vice chair of supervision, and she's still very concerned about the job market and says that the Fed needs to stand ready to cut rates. Bowman saying, quote, absent a clear and sustained improvement in the job market, then the Fed should remain ready to adjust policy to bring it closer to neutral. Josh.
All right, Jen, thank you. Well, stocks searching for direction here. The S&P 500 poised to end a volatile week lower as earnings and ongoing geopolitical tensions kept investors on edge. Joining me now on the latest market action, we got Karl Farmer, Rockland Trust Vice President and Portfolio Manager. Karl, maybe start with those comments by President Trump this morning. Certainly got some attention, Karl, because he's saying, you know what, maybe Kevin Hassett doesn't get the nod for Fed chair because he says, you know, Kevin's just too good on camera. We've got to keep him in front of reporters. He just makes the case too well. What did you make of that, Karl? It got some attention. What do you just make of the broader race here for the next Fed head?
No, sure. Happy Friday. Thanks for having me on today. So, as you mentioned, there's certainly some more speculation now that others have been singled out as possible next heads. One thing also to be mindful of is that Powell may still be one of the board of governors and certainly a potential voting member as we look to determine who has input. It's kind of difficult to imagine, given where inflation still is closer to 3% instead of 2%, and the bond market is still pricing in basically zero chance that there will be a cut this month and less than a 50-50 chance as we move out till June. So we'll see how this plays out, but so far I think different people are making are certainly making their opinions known.
So that's the markets, Karl. What's your base case for 2026? For how many cuts?
Really kind of looking at around 2. I mean, that would get us really with a bottom around 3 to 3.25. And anything lower than that, we would really need to see evidence that inflation is pushing lower, or that there's a need to stimulate the economy, perhaps if there is a weakening in the job market. But if, as the previous comments, if there's stability and unemployment stays around 4.5% and doesn't head towards 5%, maybe that will be about all we see.
Let me bring you these headlines too, though, Karl, just on this same topic. I thought this was interesting. It certainly got some attention. Federal Reserve Vice Chair for Supervision, Michelle Bowman, saying today, you know, calling out this job market of ours, how it could weaken quickly. It could mean the Fed should sort of stand ready to cut if needed. Per Reuters, Karl, here's what Bowman said. Absent a clear and sustained improvement in labor market conditions, we should remain ready to adjust policy to bring it closer to neutral, Bowman saying. That got some attention as well today. I'm just curious, what do you make of that, Karl?
It really is kind of tough given, I mean, if we recall back, it wasn't long ago that the government was in a shutdown and we weren't even getting sort of up-to-the-minute data that the Fed was making decisions on as far as the economy is concerned. So it will be interesting to see how this plays out. I mean, it certainly... the Fed has access to the best information about the economy in terms of how employment looks, how different areas of strength and weakness are playing out. But it is still sort of difficult to see that if a lot of the artificial intelligence gains that are being cited as efficiencies next year are the result of human capital savings, it'll be interesting to see how that affects the job market, and perhaps you will need some stimulus to fight that other kind of leg of the stool that the Fed is responsible for.
Karl, switching to earnings season, because we're making our way through that as well. We got the big banks this week. Curious so far, Karl, what do you make of what you're seeing and hearing?
Well, the banks again historically start things off for the quarter, and you kind of get a vision of what Morgan Stanley or JP Morgan, Goldman Sachs, and some of the large ones are seeing out there. And I think you're starting to see a little bit of separation. When I say that, the market's pushed up to levels that investors really do need to see some results as they were envisioning, or perhaps even better. Certainly the market has had some fantastic years here recently and pushed valuations up to 22 times next year's estimated earnings. 30-year average is 17. So I think as we push further, a lot of the estimated growth, earnings growth that is foreseen for 26 and 27, it's about 15% per year, and over half of that growth is supposed to come from technology. So although banks are starting us off, I think there's going to be a lot of individual stock volatility around these results.
What about small caps? What do I do with those pint-sized companies, Karl? I mean, I'm looking here. They're in the green again today. The IWM is up about 8% already this year. Do you like the small caps here, Karl?
So in terms of relative valuations, you're absolutely right. Seeing some fire underneath the small caps is always welcome in terms of broadening out the results. One fear, kind of historically, if you look back decades, that, kind of getting your bang for your buck, there's a lot of risk in small caps, but certainly a lot of rewards, as a lot of large companies were formerly small caps. One of the things that's different now, however, is some of these small companies have access to capital without having to be a public company. So some of the companies that used to start off small are remaining private, and when they become public, they're actually large cap. So as we move forward, it may be difficult to say that small caps, in theory, for the next couple of decades, are going to outperform their large cap brethren.
Let's end here, Karl, on a pick or two. Intercontinental Exchange. Now that's interesting. The Street, by the way, loves this name, Karl. I'm looking at this is nearly 90% of analysts say it's a buy. I see 0 sells. You like it too. How come?
Well, we're trying to find names that are honestly less caught in the AI spotlight right now. This is one of those. So Intercontinental Exchange and Data Services, very stable. Whether it's looking at options, futures, the energy trade. Another aspect that's not mentioned because it's still a small part of the business is the growing mortgage origination platform. They've also signed, it's really small, but a recent prediction market deal. So the stock's off 10%, got 12% earnings growth, it's trading at a market multiple. We like it not only for some growth, but also for defensive purposes.
Finally, Karl, how about Copart? That one's down about 30% over the past 12 months. You say that's an opportunity.
We really think it is. So they're a leader in the car auction salvage space. They're still benefiting from secular tailwinds, including ever-increasing total loss rates. So they've got a growing non-insurance and international opportunities. You can think like dealer or fleet sales. And those will also boast higher margins as they build that out. Those will naturally expand. So they're making long-term investments now in capacity like land and storage, and for the expected growth of supply. As you cited, it's off over 30% since May. You're getting high single-digit growth at a market multiple valuation, and it's not necessarily reliant on what's happening with artificial intelligence. So we like that name here.
Karl, appreciate your time and those picks. Have a great weekend.
Hey, thanks a lot. You do the same.
Now time for some of today's trending tickers. We're going to start here with Honeywell. That stock getting an upgrade over JP Morgan from lifting its rating from neutral to overweight. JP Morgan noting the company's messy 2026 earnings profile creates an opportunity ahead of the looming breakup. JP Morgan adding that it is expecting clarity on many key fronts the next 6 months. Honeywell is intending to break up into 3 independent companies. The business segments include building automation, industrial automation, and process automation and technology. Next up, OpenAI announcing it is dipping into the advertising arena. Company saying in the coming weeks, it is planning to start testing ads in the U.S. for the free and go tiers. The move is aimed at providing users the ability to benefit from its tools with fewer usage limits or without having to pay. OpenAI also clarifying that Plus, Pro, Business, and Enterprise subscriptions will not include ads. Introducing ads to ChatGPT could help OpenAI tap into revenue in digital advertising that has long been a driver for big tech companies like Google and Meta. And lastly, Morgan Stanley getting bearish on food companies here. The firm lowering its rating on J.M. Smucker from overweight to equal weight. Kraft Heinz gets a downgrade from equal weight to underweight. The analyst noting increased competitive risks for U.S. food and points out particularly acute risks for Kraft Heinz given recent momentum of private label foods. Well, coming up, Netflix kicks off tech earnings with its fourth quarter results. That's next week. We hone in on what investors need to know next on Market Domination. Expectations are high heading into Netflix's fourth quarter earnings report. Analysts are expecting a solid quarter, but shares have been hit hard over the past 6 months. My next guest says the fundamentals are still lining up, even with plenty of noise around the stock, including, of course, the company's Warner Brothers Discovery deal. For more, we're bringing in now Santosh Rao, head of research at Manhattan Venture Partners. Santosh, great to see you. So some interesting news this week on Netflix, Santosh. Maybe we'll start there because you saw this. Reports that Netflix working on revised terms for its WBD offer, thinking about making an all-cash offer. Santosh, you saw that. Of course, the point there, try and speed up a sale. What'd you make of that news, Santosh? And listen, bottom line, do you think a deal gets done here?
Yeah, so great to see you, Josh. I think that's good, an all-cash deal. I think that takes away some noise around it. I think in the end, I want the deal to go through. I think it'll be great for Netflix to have this content library that Warner will bring. So I want that to succeed. I think it's a good deal and they can afford to do it. They have the cash, they have the ability, they have the balance sheet to do that. So I think that's a good news actually, what they did. So they're trying everything because they don't want this to slip away from their hands. So that's a good move. So
you like the deal, Santosh. Sounds like you like it strategically, you like it financially. Let's say the deal gets done, Santosh. I am curious, how do you try to game out how regulators would respond and react?
Yeah, that's a whole different thing. So yes, that issue is there. That's a wild card. But I think overall they should approve it because I don't think it really hampers any in terms of monopoly or anything. There are no such issues like that. This is strategic. It'll improve the marketplace. It'll improve the competitive landscape, and I don't think it should hinder from the regulatory standpoint. But you never know what they can say. But if anything, I think this will get approved better than the Paramount deal. So in terms of regulators. It's tough to call. I'm not a legal scholar here, but overall, from the face of it, reading and listening to experts, I think it should pass in the end. I'm sure there'll be some carve out, something you may have to give up here and there, but overall, I think it'll get approved.
Santosh, there was also, listen, because of this deal, there has been some hand-wringing in Hollywood, right? We know this. So I thought it was interesting. Ted Sarandos, Netflix co-CEO, speaking in the New York Times, in a story published today, Santosh, I thought these were interesting comments. He says, if we're going to be in the theatrical business, and we're competitive people, he says, we want to win. I want to win opening weekend. I want to win box office. What do you make of that, Santosh? Do you think he's being serious there? I ask only because it was interesting. We had Rich Greenfield, very smart analyst, on Yahoo Finance this morning, and Rich was making the point, like box office, okay, at the end of the day, Rich was saying attendance, actual butts in seats, it's like down 50% from pre-COVID levels. I'm just curious what you made of that, Santosh. How competitive, how aggressive you think they really want to get in the box office?
Yeah, I think, from the statement, it looks like they want to get very competitive. See, this whole space is kind of getting very competitive. That incremental dollar you need to get more creative, you need to get more innovative. So I think they're going all out. So that's a little surprise. I think Rich is a better expert on that, so I would go with whatever he said. But on the face of it, I think, they want to do it. They want to go big. Right now, their business, their core business, at this point, it's more about execution there. The easy money, the easy subscriber is in already. So now for the next incremental subscriber, they really will have to work. So to grow their whole revenue base, they'll grow their market share, they have to expand, they have to go beyond their narrow lane and into other areas, which they are doing. A lot of live events, a lot of other things, the new slate of offerings. So they're doing everything. So I think they have to explore every opportunity, even if it's box office stuff, and just get good at everything. So they will do all out. They will go all out wherever there's an opportunity. They will tap into it.
So when they report, Santosh, when that Netflix earnings hits the wire, you sound like you're bullish, you're constructive, you're expecting good news.
Yes, so there are two aspects to it. There's going to be near-term volatility because there is this big overhang. You always have that regulatory overhang. You don't know whether it'll get approved in the end, but I think it will, but you never know. So I think that'll hold the stock. So the stock's not running away. They had a very underwhelming third quarter. So I think the expectations were lower. So they will beat that number. But going forward, I think guidance is important. Long term, I expect the stock to go back up. It's a great buying opportunity here. Let all the noise settle, buy it and at least leave it there or wait to get back in. But in the long run, you're going to see the stock go up and right because there's still a lot of levers they can pull and the stock can continue to go up. So yes, here the commentary is more important. What they're thinking about the acquisition, about the M&A, all that stuff, people need to know the qualitative aspect there. Then looking ahead, we want to see the guidance as well a little bit. But I think we know it's really a long-term story, long-term execution story, which I think they will perform very well.
Last question, Santosh. I mean, one question is, to kind of wrap this all together, a concern you'll hear, of course, about Netflix is, okay, the skeptics will say, the reason they're making this bid for WBD is because they're actually seeing weakness, organic weakness. You know, they're seeing weakness in engagement and subscriber growth. And maybe we'll have better line of sight when they report, Santosh. It sounds like maybe you disagree with that skepticism.
No, to some extent, I think they need this acquisition. They need that M&A. Yes, things are, I mean, when you're the best in town, everyone's going to go after you. You're the best of breed. You need to keep that competitive edge. Yes, that's what's happening. Things are slowing down. The rate of growth is kind of slowing down, but they are growing. And so, yes, it is a concern, but I think overall, I think in the long term, they can really manage it very well. I'm not saying it's a straightaway outright win, but they can grow that. They have the opportunities to execute and get there and do very well. And they will. But that's the main thing. I'm not saying things are just easy. Yes, they need to make acquisition, which is what M&A is all about. You need to plug the holes, make those acquisitions to kind of keep growing your core business and other businesses, go into other areas, adjacent areas, which Netflix is doing. And they're on the right track. So yes, near-term concerns, yes, they needed to do this, they need to do it, but in the long term, it will definitely make the company very solid in terms of the offering and the slate and the ecosystem that they will have.
Santosh, always great to have you on the show. Thank you.
Great. Thanks for having me.
Well, the year is just getting started and markets have already been on a volatile ride. For investors looking for some insurance, there's a way to play it via the options market. Yahoo Finance's Jared Blickry shares what you need to know in this week's options playbook, sponsored by Tasty Trade. Jared.
Thank you. The Dow, the S&P 500, they have been hitting records this year, but the NASDAQ barely positive. That's because big tech has been going sideways for 3 months. And today we're breaking down a simple, real-world way to hedge the Qs. That's the Invesco NASDAQ 100 ETF, ticker QQQ. So let's say you've been long the Qs from $400 a share since early 2024, which was right when it was breaking out from the old 2021 highs. Fast forward to today, it's around $620. And on 100 shares, that's about 22 grand in unrealized gains or paper profits if you haven't taken them yet. You still like to trade long term, but you're worried that a short-term hiccup could turn into a bigger downturn. Perfect for an options trade. So let's hear how RBC's options guru, Amy Wu Silverman, recently framed it to Yahoo Finance.
Hey, if I've made decent gains from AI, if I'm worried about valuation, if I think maybe there is an AI bubble and, maybe it pops temporarily, how do I capitalize on that? How do I buy myself a little insurance?
That insurance is what's called in option terms a put. It's a contract that gives you the right to sell 100 shares of a stock, index, or ETF at a set price. That's the strike. It has a deadline, that's the expiration or expiry, and you pay for it up front. That cost is a premium. If nothing bad happens, you can lose that premium. That's the trade. And now let's get more specific. We own 100 shares of QQQ. We want insurance if the Qs drop more than 5%, which brings us to the 590 price level or strike. And we're only worried about a short-term drop, so we choose an expiration about a month away. We're going to go for the February 20, 2026 expiration date, so we pay a premium or upfront cost of $4.80, which comes to $480 for one options contract, which again is worth 100 shares. As Amy says,
this is a way to systematically get a little insurance for the downside, but without leaving upside on the table.
Now let's take a look at how this trade maps to a typical options profit and loss chart. First, notice it's all green, no red. That's because we're already sitting on $22,000 in profit, and all we're doing is protecting a chunk of it. At no point do we give all that back and lose money. On the left side of the chart going up, we have our profit amount. And at the bottom, those numbers represent the final price of the QQQ ETF on expiration, February 20th. That blue dotted line is the current price, about $620, and you'll notice as we go left from it, the profit line gently drops to where the red dotted line is. That line is a 590 strike, and we're steadily losing money until we get there. But notice that at that point, the profit flatlines and stays steady no matter how low the price goes. So you're actually locking in $18,520 in profits, which is the worst case scenario. No further losses if the Qs keep dropping. Also notice that to the right, the profit line keeps going steadily up. So you still make gains if the Qs rally, and that's because you still own the shares. And you just paid $480 for protection, which you don't get back. Now let's review the quick decision list. The pros, you stay invested in QQQ. You limit the damage if the market drops hard and fast. And your cost is known up front, the premium. Cons are, you're paying for something that you might not use. The protection only lasts for so long, so it expires, and it won't really help you out if the Qs don't fall enough to get into that protected zone. But what if tech keeps running? Now here's Amy again.
Let's say that Qs do what they do best, which is they actually rip into February. You do lose that premium paid on those put options. However, you haven't capped any upside. So if that FOMO, that YOLO, and that MOMO keep going, you still own it.
And that's the whole point. You're not selling your winner, you're just buying a little time-limited insurance on it. Back to you, Josh.
All right, thank you, Jared. Well, we're wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.